Okay, welcome everybody to CyberBulls. We just heard Fed's talking about an additional rate hike. Let's get started with what we heard from Elon, and he's basically saying that this is a foolish rate hike, will worsen depositor flight, and it's a major driver of people moving their money away is because of people moving from low interest savings accounts to high interest money market accounts. And then previously, he was actually recommending that there should be 50 basis point rate cuts. So let's get started with you, Jeff. Tell us what did you hear? Give us a summary of everything that you heard at the call today.
Yeah, so the rates were increased 0.25%. The Fed funds rate is 4.75 to 5%. I just took some notes from the call. So, one of the things that's happened naturally since the last FOMC is there's been tightening that's been kind of above plan, is the way that kind of Powell referred to it, meaning between the last, he was asked about financial conditions and he said, yeah, look, they're tighter. And that's really as a result of what's happened over the last 2 weeks on the banking side, which he addressed as kind of an initial statement before he got into his formally prepared statement. He issued a statement on the banks and how all depositors will be safe. And then he basically said inflation's still too high. The target's still 2%. He reaffirmed that target. He said spending slowed at the Q4 of last year, but started picking up again in Q1. Housing is weak. The Fed's projection of GDP would be 0.4% by the end of this year, which would be some contraction from where we are today and below trend growth. And then just 1.2% in 2024, which is a presidential election year. He said wage growth, there's some sides of slowing on the wage growth side. They just don't know the extent, but that's the key thing they're looking at. But the unemployment side is still too low. They're projecting 4.5% unemployment, so basically almost a percent increase in unemployment between now and the end of the year. He said inflation's moderated, but it's still too high. He says the path between where we are today and 2% should be steady, and it can be bumpy along the way, though, is the term he used. The economic indicators have been, and that's what he's concerned about, those January readings were a little bit stronger than he liked, and then February was slightly better, but still elevated. But he says, the economic indicators have generally been stronger. But the key theme, like kind of tying it all together, is these banking issues are going to tighten access to credit, and they just don't know the extent of that. They don't know the depth and breadth of that. We're 2 weeks into this, and that's why they changed their formal statement around instead of saying ongoing rate hikes are necessary, they changed the terms of firming the policy position moving forward. And then he further defined firming as, instead of ongoing, it means may and some. So may be some rate increases or at some level. So may and some replaced ongoing on the rate side. And then he broke down inflation. He says, look, goods are coming down. Housing's just a matter of time. He said the new leases are showing that. He says, the non-housing services is what's sticky, and in even some areas, elevating in some areas. So that's 56% of what he's looking at. The 44% of it is coming down, which are goods and housing. So this is really coming down to credit for them, which the Fed is pretty scared of. A credit crisis would be a pretty big deal for the Fed. And I'm sure some of you can comment on that later. He was also asked, finally, do you see a pathway to a soft landing? He says, well, based on the last couple of weeks, it certainly didn't get better, but he goes, it's still possible. And he says they don't have rate cuts in their base case for this year. So, in closing, I think they're trying to have a little bit of their cake and eat it too. They're trying to acknowledge what's happened from a credit perspective and a tightening perspective. He viewed what happened in the banking side as a tightening exercise that should help bring down inflation. They just don't know the depth or extent. So they went with a quarter point, and the questions, and the outlook, still has fairly high rates through the end of the year. Again, no cuts. So I'll pause there, and we can open it up to others.
What did you guys think about the impact? What's the impact to the market? Did they just accept the fact that they were expecting a 25 basis rate hike anyways? And then, the way that they actually separated out the banking crisis away from inflation, fighting the inflation, and yet they did at least recognize, saying that the bank tightening credit is equivalent to a rate hike also. How did you guys see that it's going to impact to the market, and what's the outlook for Tesla as we move forward here? Who wants to answer that?
I'm just quickly scanning the markets. They've literally peaked and trough about 4 times between when I'm looking at the NASDAQ, which is where Tesla is, and kind of closely correlated, to the NASDAQ. And it's got about 3 peaks today. It was kind of steady and chopping into his announcement. And then since the announcement, it chopped a bit, much higher peaks, and then it went up pretty high. It went up to about 142 point gain throughout about the midpoint of his press conference, and then it came down. It came down about a 50, 60 point loss, and now it's on the upswing again. So it's unstable, and this is fairly common, I would say. There's a lot of volatility on FOMC day and the presser day, but so far. It's not horribly moving in one direction versus another. We could have an interesting close, and then tomorrow it could be the exact opposite of where we close. So it'll be interesting to see.
Mm-hmm. Anybody else? Alexandra?
I'm not surprised that it's down a little bit today, and I actually expect it to be further down in the next couple of days after people have digested it and after we get the minutes. I found him grossly uninspiring. I really felt there was absolutely nothing positive coming out of it. I found them, in everything they said, slow to adapt to current circumstances. It was like, oh, we don't know yet. I don't know how many. I started counting how many times he said, we don't know. And then I gave up because it was just all over the place. We don't know this. We don't know that. We don't know in the past. We don't know in the future. It was really getting to me. Everything was linked to this lagging. We're lagging past indicators. We're lagging a view on the future, how this credit crisis will play out. We're lagging any initiative to be able to measure it yet. We're lagging this, we're lagging that. I found him so uninspiring is really the one word that comes with me. He obviously at the beginning tried to reassure. He started off with the banks and how this situation is now under control. Under control we'll see, but under control how they wanted it. He egged around saying, are all deposits guaranteed or not? He had a standard phrase that he repeated twice there, but it was I'm not saying more, I'm not saying less. It's not sure it's for all banks. I'm saying everybody should be reassured. This egging around, I can't take it. He never addressed residential housing. He addressed commercial housing because he was asked for that. He didn't address residential housing. He didn't address car loans, which I think is going to be the first thing driving against the wall. We talked about that. His soft landing stance on we don't have a base case with the rate cut this year. We're in March. On one side, you tell us you don't know anything. You have no clue how the last 2 weeks are going to play out and whatever. But you already know that for the next 9 months, you have no base case in which you would consider lowering the rates. So I found him stuck in an old scenario, difficult to adopt, difficult to absorb any new data rapidly. Obviously, scared as hell of new technology. The one thing that came over was like, oh my God, the news travels so quick. Well, yeah, you better adapt. News now travels quick. That's how SVB depositors knew much earlier than anything happened. Get a Twitter account, Jerome. That's probably going to help. The whole I just feel I'm back 30 years talking to people that in that scenario, when there was only newspapers and all that, knew what they were doing, but are completely overwhelmed with the speed of information, of data, of clear indicators that the economy is really at the brink of smashing into a wall and don't want to see it. So I was getting out of there really with bellyache.
Okay. And then Farzad, you were saying earlier, you are not expecting a soft landing anymore.
No.
What's your outlook and how does this look for Tesla?
Well, can I share my screen and show you just a few things that I'm looking at so that we can sort of, and thank you for having me on, by the way. I appreciate it. Hopefully I can make some sense. So I will come in as a person that is probably not well, at least you guys have been following this, I think, much more effectively than I have. So I'm coming in from like a layman's perspective where I'm just a dumb person who's trying to make sense of all this stuff. Okay. So this is what I see. And you guys tell me if I'm stupid. Okay. So historically, we're seeing an interest rate now up to 4.75 that historically speaking ain't that high. Right. But then in the last few weeks, we've had four however many bank failures from historically average interest rates that obviously happened because of how quickly we changed the rates and how not well equipped the governing systems are to see what happened ahead of time. And so to say, well, let's just keep doing the thing that caused that seems stupid to me. So that's number one. Just common sense would say that seems weird. Then the other thing I'm looking at are savings rates, right? So if I'm looking at personal savings for the last 10 years, this is from the Fred economic research database. Everybody has access to this. Personal savings seem to be below average for the last 10 years, meaning that people don't have as much savings as they had in the past. Then we have a savings rate, which is what percentage of the percentage of income people are saving seem to be significantly below average, historically low for the last 10 years. So people have low savings in relation to the last 10 years, and they're saving less often than they usually do. Cool. Then we have credit card debt that's almost at historic highs. And like Alexandra said, we have car loans that are just insane to me, right? And all of this is with the backdrop of record low unemployment, okay? And so what the data this says to me is that it seems like the average American, and it seems like the average American is strapped for cash. They are not saving as much as they should. They don't have as many savings as they used to for the last 10 years. They have record high debt. I didn't even show the mortgage debt, but we all know that's a record high. And at peak unemployment, meaning at the lowest rate of unemployment, we have an economic system, it seems like an economy, where people are strapped for cash. And so what this obviously points to is that as the Fed, they're obviously on a warpath to whatever this inflation reduction is. They're clearly going to do it by slowing down the economy, which I have a hard time believing that it's not going to cause an unemployment spike, that we're going to have more people out of work. If this is the case, what happens to all those people that fit this? Record high auto loans, record high household debt, record high credit card debt, record low savings rates, and like historically low savings. What's going to happen there? Is just magically they're going to find money? That's what I'm concerned about.
No, in the wall. That's what he wants.
That's what I'm concerned about.
That's what he's after.
Yeah.
Yeah. Yeah, but that's exactly, and he said it. He said it. They're waiting for unemployment to go up. I mean, it just drives me crazy.
So, yeah, I think a million people, I think a percent in unemployment, it could be roughly 1 million people. I think we should go look at that math, but it's a lot of people that would have to come out of the labor market to get to 4.5%.
I just don't see how that is. How is that going to have a good ending? Like, what does soft landing mean? Can somebody help me understand what soft landing means? Seriously,
it's gone.
Yeah.
Well, the soft landing is gone, especially since obviously they still have in the books another 25% hike. I mean, he was trying to temper it down a little bit, saying we changed our language. Now it may be, what was it? Policy firming. And then when that journalist asked him, what do you mean with policy firming? He said, rate hikes. So we may have another rate hike. And that's what the dot plot also indicates. So rather than thinking, how close to the wall we are and how how much more expensive credit will get very quickly for all these people that have outstanding credit, student loans and credit card debt, and obviously auto loans and variable mortgage rates for those that have variable mortgage rates. I mean, he sees that. I can't imagine he can't see it, but he is refusing to understand that the moment is now, and just gives it another 2 months here, 3 months there. And so the soft landing is gone. I was a big believer in the soft landing 2-3 months ago, but I just don't believe in it at all anymore. And the crash, the bubble will come really from a couple of things. I mean, residential housing. After today's meeting, I would have to sell a house. I'd put it on the market now. It can only get worse. What he just said, the next 9 months, it's only going to get worse.
Yeah, soft landing is getting to the 2% inflation target without crashing, the economy and not getting into a recession, basically. So that's soft landing in terms of a definition. The question is what's the probability of that? And I think it's much lower. So I mean, it'd be interesting to see. Like, he was asked multiple times on, like, how do you see the banks? Are the banks okay? Is there adequate liquidity? He's like, yes. And I mean, what if a bank fails later today or tomorrow?
They said that before.
Yeah, that happened during the.
He
said that 2 weeks ago.
Yeah,
he said that 2 weeks ago. Watch Bank of America. Bank of America. That will be the big one. That's the one joker they have to protect. Oh, there he is. Herbert is always in the good banks. There you go.
No, I'm not in Bank of America, but that scares the crap out of me if Bank of America has an issue. That's the big.
For the record, we're not stating anything here on this that there should be. But no. Yeah.
I mean, I think
we know exactly what we're talking about.
Yeah. Well, that is my point. Okay, I'm the average Joe. What I heard right now did not give me confidence, because he just kind of separated the banking crisis away from the inflation. He thinks that banks are fine. He needed to calm people down. And then I'm looking at Elon, who's pretty well called it properly. We all understand that Elon, because of his multiple companies, has significant viewpoint, and he's calling for a 50 basis point rate cut now. And so he's now warning us that this was a ridiculous rate hike, in addition to not even just a pause. And so, the banking crisis could get worse. And that, as an average Joe, I'm not satisfied with what I heard. And I can see what's happening with the market. They're kind of, reacting the same way. So it wasn't handled well. I don't know, but let's get to you, Xander. You are pretty well following closely the market. You have made some bets. What you're thinking of how the market is reacting to this?
It's kind of expected. I think it was about an 86% or something like that it was going to be a quarter point hike. So the market priced that in, and I sold some 220 calls for this Friday when we had that 7% pop on that day, and closed it today for a 50% gain. I kind of predicted that you'd have like this W shape where it'll go, it'll go up, it'll go down. It's very volatile. A lot of the market plays these types of events. So it's a wild ride. You can't really predict which way it's going to go. But, I guess I kind of, I don't know if I would say disagree with you guys a little bit, in that I think that this is exactly what the point of all of this is that you're trying to slow people's spending and change their habits. If people are living outside of their means, how can you change behavior? And it is going to get to the point where jobs have to be lost, and we're seeing that in the tech sector. And hopefully it's not like it doesn't get to the point where it's the little guys that get hurt the most. But even I'm talking with my wife about lowering our overhead and moving to a smaller place. I even brought up, maybe we should sell the Model X. Anything but
that.
Right, exactly. But the point is that these conversations should be happening across America. And when you have so much money that's in the system, and that, like, I didn't want government money. As a business owner, leave me alone. Let me do what I do, and I believe in that. So yeah, it's kind of an interesting situation. But to your question, Herbert, now it's at the 194. I was trying to reopen my calls at 200, and I missed it. It didn't get quite as high as what I wanted, and now we're on the way down. So I think tomorrow we'll see, not a big green day. Let's just put it that way.
Yeah. To me, it all feels so. And Xander, I agree with you. I think the Fed has been very transparent from the very beginning that for inflation to come down in their eyes, they had to slow down the economy through the tools that they had, and this is obviously the result of that. What's just so weird to me is that we get to see it, that even after a near systematic collapse of the banking system, I would argue, they still continue to do the thing that caused it. It's just mind, and maybe I'm just stupid. Like that to me, doesn't that, maybe as a layman idiot, doesn't that mean, stop, slow down? Like maybe we shouldn't keep doing the thing that caused the problem. Maybe pause,
Yeah, I think that they think that they have tools in their belt that they can use to, as a hole is sprung in the boat, they can address it. So if they're able to, the soft landing is gone, but perhaps you can reach your target.
Yeah, I think what this reminds me
of. I agree with you, Xander, but
sorry.
Yeah, go ahead. No, I agree with you. But the one thing is that at the same time, we don't know. We'll have to wait to find out and whatever. Yet you do it, right? So,
exactly.
So I would have really preferred that pause here and wait, because he admitted he has to wait. He doesn't know, and I just think the 25 basis points, with the hint that there may be the next one just around the corner, a little bit on the high side. Now. Go ahead, Farzad, because I have a completely other point I want to make later.
No, that's fine. No problem at all. To me, I couldn't agree with you more. I think for me, it just seems like the Fed. I've seen this in my career before, and I haven't been around, but it's like to me, it feels like there are a lot of really smart people at the Fed, very brilliant minded people that are trying to overcomplicate something that just needs some common sense to me. And I'm speaking from a layman's perspective. And I think we're getting ourselves into a situation where this keeps repeating. If you look back to the different sort of economic crises that we've had, is when we get a little too clever, stuff happens that we didn't expect because we got a little too clever. Instead of common sense coming in and taking over, because in the end, the economy is a psychology thing. Otherwise, we wouldn't have record debt. If people were really good at finances and we all were kind of like, let's just be the best financially responsible people ever, we would not be in the situation we are now. So clearly the economy is in a lot of ways psychological. So then why not take a step that is obviously common sense, but not take it? And that to me, I feel like whenever we get to that point, we're probably 6 months too late. That's what because you've allowed all these things to systematically propagate. You've embedded all these trends into the system, and when the verbiage and the tone changes from those people that says, well, maybe we've gone too far, theoretically you should see a change. But then if they continue down the path, then it means okay, so that you're not looking at the right thing, in my opinion. So
I think the problem they're seeing is that spending picked up in Q1 and jobs even heated up. And so they're like, well, wait a minute, all these we started the 0.75 increases in June, and they're probably a little bit surprised that there would be strength in those areas. Again, I'm not speaking for them. I'm not happy about more rate increases. I'm trying to break it down. So the non-housing piece of it and the non-goods piece, it seems like they've gotten to chunks of inflation and they feel better about what's happening. But this services piece is where they're freaking out. And it's 56% of the inflation that they're looking to
but wages,
on that
right?
Non-housing services. So he said wages are flattening, like doing better, like not spiraling, up, so it's more of just the labor market is tight, and spending actually it tightened a bit in Q4, and then it picked up in Q1. So there's kind of like a tale of like multiple things going on out there. What I'm concerned about is, okay, we have this going on with banks now. What if another sector, what if the bank, first off, we don't know the extent of the bank thing. He even said it's like it's too new. It's a couple of weeks in. What if another sector kicks in? Like, what all of a sudden, like, one of the auto manufacturers
and everything
says,
linked to loans. Right.
Yeah.
Yeah.
They didn't see the banks. Why would
loans.
they see anything else? Like, why they didn't see the banks? Why would they see anything else?
Exactly.
Yeah.
And let
The
me just
problem
quickly
was-
get back to the services, because when I looked at the services of the, what was it, February CPI, it was mainly travel, right? Of course, the airlines have all increased prices for the airplane tickets because people are traveling now again. The planes are full, so they can ask more. That is, for me, a very quick fix, right? I mean, this is something that I don't think you need a Fed hike to overcome that. I mean, if the prices get too high, people won't travel. That's just it. So I really feel that they're sticking to some stuff that has no relevance at all, but they don't seeing the big elephant in the room, which are all these loans of all types that are just going to go against the wall. I don't understand it. And I just want to add what I forgot earlier. Sorry about that. So when I said big, be careful with Bank of America. Bank of America for me is the weakest point of the big American banks. But what I really mean is, if you have on any business or a private checking or savings account more than 250,000 for an individual at any bank, you have two solutions. Open bank accounts at different banks, because the insurance system is going to work no matter what. So spread it over multiple banks if that's possible. And if not, buy money market funds with treasury bills in it. That's the best way for you to be insured. You'll have a little cost to it, but it's giving you daily liquidity, and it's giving you what you need, and you have it off the bank's balance sheet assets side. So just throwing that out if anybody didn't know about that.
That's good advice.
So the issue that I feel is that, yesterday, Jeff, you were saying that you think that they should do a 25 basis point rate hike, which is what they did, but that they would be then dovish in their guidance. That's not what I heard. I heard them being pretty hawkish, that it possibly even 25, maybe we don't know. We got to focus on inflation. We think the banking's fine. Everything's good there. Don't look at that. But that does not give me good feelings, because, and not that I'm not saying that they should give me good feelings, but it is the worst thing to do right now, honestly, because you're creating this crisis even worse when you set it up that way. So it's the worst case scenario as far as I was concerned.
They did change their policy from ongoing rate increases to firming, which is May and some. So what they're saying is the extent of their headlights may be even shorter than they were before, and they're going to react to what they see. And I think, to Alexandra's point and Farzad's point, that's that in itself, it could be destabilizing or concerning. But they did change their. I mean, that was, he didn't say 25 and we're looking for ongoing rate increases. I mean, he said 25 and then he went to a firming policy position, which is May and some. So I think what they admitted is that showing a 1 year dot plot, they're basically saying, like, we don't have the ability to predict this out that far. We'll show you it, but or the data says that we're not very good at predicting this. So, I'm a bit mixed on this. I think there was like 82% probability of a 25-point rate hike. They didn't commit to future rate hikes, although what the dot plot says, it looks like there's at least one more in there. They did say they don't have cuts in their base case. But that just means that's as good as their forecasting is and what they have on the table today. So he was kind of all over the place. He kind of wanted to have his cake and eat it too, is kind of what, he wanted to get that one more rate increase in and say, hey, look, inflation's important. 2%, as he reaffirmed 2%. he reaffirmed that there's some parts of it that are really sticky that are not coming down, and we're making some progress in other areas. So kind of wanted to have his cake and eat it too. But he did say, they are going to kind of look around now. It wasn't like 25 today and expect 25 at the next meeting.
Okay. Can I show what Elon has been doing in the last several minutes? Or I don't know if you can see this. I don't know how I can make it bigger. So he is saying, I don't know. Can you guys see this? How do I make this bigger?
Yeah,
okay.
We can see everything.
Basically,
we can see it.
Watcher Guru says, just in, the Fed Chair Jerome Powell says the banking system is safe. And then Chairman says, we should just make GPT-4 the chairman of the Federal Reserve. Elon replies, says, couldn't do worse.
There you go.
And another comment, all goes cringed when Jay Powell said 2% inflation is still the goal. Keep dreaming. Jay Powell has Volcker envy big time. Go ahead, Alexander. Tell us what he means by that.
I don't know what he means by it, but I have to say it is, I'm as disappointed as Elon. I mean, Elon obviously yesterday, remember we talked about that, said that Powell should lower the rates the Fed should lower the rates by 50 basis points. So he sees the danger. He sees the danger of the economy. He sees it obviously in all his 5 companies. So it's not as if he is not well placed to understand how the economy works and has the finger on the pulse. I said it in my opening statement earlier. I just found them so distanced from everything that's happening. They have their roadmap. Inflation has to go to 2%. Half of their mission is to get jobs under control. Wow, yes, jobs are under control. So now we can concentrate on inflation. That's it. We've got a tunnel vision. That's what we do. Now, I do completely understand that they should have people that are more on the pulse of the economy. And I don't think they do. When he said at one moment, we have all these studies, how this all interacts, higher rates, unemployment, credit, and all that. We have all these studies, but we have to see whether it plays out this way. I was like, well, if you have all these studies, where are we going? I mean, read them, your studies, do it.
Yeah. The other thing he said when he was looking at when he was asked what happened with the oversight with SVP and will regulation need to change going forward, he says, well, they failed badly because of management. We're still going to review what went wrong. It might take them 2 weeks, 3 weeks. It sounded like, oh, we're going to just find out first and then we'll make recommendations for policy changes. I just felt like, okay, you guys all realize this is a crisis happening like every 10 seconds.
I know.
You need to act fast, not just, well, we'll see what's going on.
And market-wise, we're at the lows of the
that's exactly
session.
how I felt.
Yeah. But isn't that Xander? You've always said that that's how the market always reacts, right? They always kind of like jump up at the beginning, and then it.
Yeah. The volatility is played, and then the market digests. But there's no U-turn here that the market's waiting for. And I kind of said this yesterday in our back channel. There is that why would the Fed want us to feel rich at this point, right? And if you do pause, that would have been a good move, and but like a 50 basis point cut that Elon was calling for, I just couldn't see that happening, because that was my response, was that why would the Fed want us to feel rich? So I think that now you're at the lows. And it's not going to be, the U-turn isn't there, and so the market's disappointed that you're not pausing, you're not listening to what we want. But at the same time, like I just shared a Gary Black tweet with you that is interesting, and it's we're getting a Tesla dip that many wanted before first quarter deliveries, so that's kind of where my focus goes to. And that the 2-year and 10-year treasuries are both plunging down 20 bips and 14 bips respectively, which is good for growth equities. Hope folks who were waiting for the dip are buying. What do you guys think of that? Is that what you think as a result of the Fed's moves that you'd be buying here? Because Alexandra, I think you disagreed with that, right?
Yeah, I mean, I'm always dollar cost averaging, so I don't sit on a lot of money where I could just put it in, but I wouldn't feel comfortable buying here yet. I still do believe the market will actually be coming to the sense that this was disappointing. There was nothing new. There was no good guidance. There was no reassuring guidance. There was a lot of, we don't know what we're doing. We have to wait. We have to wait. We have to wait. And that's never comfortable. The market likes a strong Fed with a real message, rather than saying, oh, we have to wait for this committee and we have to wait for this indicator and we have to wait for this and we have to wait for that. So I wouldn't buy here yet, but I just saw, because you shared it with us, Gary's tweet, and I was actually surprised, because Gary is hardly one that says easily buy now, and there he was very explicit. So there you go.
It's very frustrating that Tesla continues to just spit out fantastic news, and yet here we are in the macro, continue to keep it down. And I get it. I gotta have to wait a little bit longer. We got a note here, Farzad. This guy says, YouTube video is weird. Farzad is so quiet. I think he's pissed off. Are you pissed off, Farzad?
I am rarely lost for words. I have just so many thoughts going through my mind. I find it extremely ironic. I'll talk about the market a little bit here, but what I find most ironic about these actions is that the Fed is saying, well, we need to lower inflation so that the folks that have the lowest income can afford everyday groceries. And that's the key reason here, is like it has an outsized impact for the folks that have the lowest incomes. And then what are you doing? You're forcing those people to lose their jobs. It blows my mind. It blows my mind that is the policy of so like that. I can't get over that. I truly can't get over that. And I must be a moron for not understanding there must be something in there, but I guess that there isn't. I think
Sander has a point.
Yeah.
Farzad, Sander has a point when he said, people overspend and you need to slow them down. I see that point of it. But is it the same people that are going to pay the price? No, that's not how it's going to work.
Exactly.
Did you see that Facebook lady that has $190,000 a year job? She's not allowed to hire anyone, and she's working there for 6 months, and she's like, well, I ride it out as long as I can. And so I think that's the point, is like perhaps we're going to see those types of jobs where it's just the big companies are cutting that kind of spending. Sorry, Farzad, go ahead.
No, you're fine, man. I don't know. We'll see if that's the case or not. I do think what's very interesting is the entire backdrop of the backdrop of the presidential election coming through next year. I do think if we do run into a situation where the economy does start to head significantly lower, more than the Fed was projecting, which shouldn't be a shocker based on the Fed's previous trends with being late on the inflation stuff, being late to understand the banking system. A lot of us feel that they're very late in pivoting. So one would say that given their recent trend, the Fed's probably going to be very late in responding to an economic downturn. And I think with the presidential election in the wings for next year, I do wonder what kind of impact the current administration is going to have in Fed policy to try and reverse the trend that may happen, in my opinion, of severe economic downturn because of the Fed's decisions. And I wonder what that's going to do to the broader markets. Have you guys thought about that at all? Maybe that's a broader question for the panel.
Yeah, I think it's a great point. I've talked about this extensively. What the Fed is projecting is that we're going into further economic contraction, with the I think it was 1.4% GDP, and then sorry, I had the numbers written down, but basically we're going in the
0.4.
Sorry, yeah, 0. Yeah. Thank you. 0.4, and then the 1.2 next year. All of that is below trend, and that's going to be a huge topic. There's major Senate elections. I think there's 6 seats that could literally flip the Senate. There's many more seats up for election, but there's 6 critical ones, and then of course the presidential election. And you're already starting to hear politicians making statements even right after the rate increase went through this afternoon. So I think it is going to start becoming increasingly more political. And I think to kind of like tie up all the frustration, it's just not clear that increasing the cost of borrowing money is going to, and throwing people out of work, it doesn't feel like there's almost a straight line to that and lowering inflation. So that, I think that's where everybody's frustration is coming in. So I think will be interesting to see is now that he's had the press conference and now the Fed governors are all going to be off of, they're going to be allowed to speak publicly. I think they're in a quiet period. It'd be interesting to see what the rhetoric is now, because the rhetoric for the last 6 months has been jawboning markets left and right. Every time a Fed governor is interviewed, they come in and say, something to thrash markets of like, hey, we need to go higher for longer. And they throw out these dramatic rate ceilings that they're talking about. So it'll be interesting to see now that we've had banks literally failing within 24 hours of the Fed president speaking in front of Congress, and now there's been 5 of them. It'll be interesting to see what the rhetoric is like now.
Yeah.
So to bring it back to Tesla, because I'm a Tesla investor. That's why I'm here. I'm trying to understand the macro impact to Tesla, and it's been hitting it hard for the last year, and now possibly this next year. There was a comment that you made, Jeff, that the kind of the investors see Tesla as an auto company, and the auto companies don't fare really well, probably one of the worst segments during a macro downturn, and looks like that there's a tremendous uncertainty. But then you also said that it might be a temporary blip before the, kind of the powerhouse of Tesla's numbers and earnings and margins that they continue to spit out for the next year. Is that temporary, or should we just basically throw down the gauntlet and say, no, I don't know what the word is, throw it down, just say that's it. Tesla's going to just be down for the rest of this year, next year, and then maybe it'll spring back afterwards when things clear up, or what's your expectation?
There's a couple macro situations it could get caught up into. It can get caught up into the broader macro situation. And if we do enter a formal recession, that's going to means we may not have seen the lows in the market. The other recession could get caught up in, until it distinguishes itself, is a broader auto recession, which is like, hey, if GM comes out, we're right now, we're in the period where a company could literally make a statement this afternoon, even after hours today, saying, hey, we're warning about our Q1 results. So if auto companies start warning, or they have bad earnings, or they're all going to report deliveries in that first week of April, and if there's some real softness in those numbers, you could see kind of an auto segment, issue. And then Tesla would have to step out and okay, hey, wait, hang on. We're seeing EV adoption way well ahead of plan. The IRA is helping us. Our gross margins, they came down, but they're above our target of 20%. And we see it, improving quarter on quarter. And this energy segment is ramping up faster than we once thought. So Tesla has a number of rabbits they could pull out of the hat. But if they're auto macro, it could be a little bit fuzzy for a while in terms of, so Tesla can distinguish itself. That'll be the key for them.
And then Farzad, you did a deep dive in these companies. Which auto company are you most concerned about? Because like Jeff just said,
yes,
if one of these auto companies starts to get, and they are, we know this. I know that Alexandra's been warning about the financing that's going to hit these guys. One of them will suffer, and then Tesla will get hit again, right? So which one do you think might come out first?
My answer is yes, all of them probably.
Yeah,
I think it's the channel stuffing sort of thing that we've been seeing has been quite obvious, especially from GM, from one of the U.S. automakers. I think that there's a new paradigm shift happening in the auto sector where automakers are moving to lower volume, higher profit, and the dealership network inventories are reflecting that. But the days of supplies on those lower inventories are much higher, which means that even though they're getting less cars and the lots are less full, they are turning those cars at a much slower pace than they were even last year. And what this means is that these automakers, with all these factories that they've built, are sending less and less cars that are sitting idler for longer. And so and then those same cars that they're shipping for high profits are coming down in price because for the new cars, at least, because nobody's buying them. So they have to lower the price through dealer incentives. And so I think I agree with Alexandra on this a lot, is that I think this year, if we're correct as far as, or if I'm correct on the trend of the economy, let's say, because I don't want to put words in other people's mouths. Let's just say the economy is going to suffer, which means less people are going to buy cars. And to everybody else's points here, the alarm bells are going to start ringing pretty loudly, starting with Q1 earnings, I believe, because you're going to see quite a big slowdown in sales starting this quarter. And then if by Q2 we're not hearing some massive red flags from automakers around this sort of slowing automaker, then I would be surprised. I would honestly be surprised. It might signal to something that's maybe softer than I thought, because people are out there buying the car. Yeah, in my opinion. And especially this is within sort of, these automakers are expecting to sell enough cars in a economy where it's going to support 15 million new cars per year, which is higher than last year's 14 or 13.9 that it was. So automakers are doing their projections based on an auto market that's going to grow in 2023. And I just don't see how that's possible in this environment. So we might see a lot of revisions downwards. And I think I think Jeff, you were just talking about this, or it was Xander, I forget, around how you might have a problem around these automakers sounding the alarms, and then Tesla's going to have to play defense and say, it's not us. We're good. We might have to lower our prices, but we're good. So that's going to be fascinating to see if that plays out.
Alexandra.
Well, as you all know, I'm dollar cost averaging, and I'm not pausing. I mean, I do believe a little bit that between now, mid-March, to the results of Q2, end of July, it's gonna be interesting. And I don't have a crystal ball, but I just have this gut feeling that the price could still be very volatile, both lower, and then once people understand that Tesla is actually gaining market share, can rise very quickly. So I just think volatility is going to be higher. So if people are, I have no idea what my computer is doing, but there we go. So if people are, planning to invest, for me, the thing that gives me the most comfort is just to dollar cost averaging whenever I have availability, and then I don't have to think about it. But if somebody wants to be more clever, maybe waiting it out until middle to end of July may be a good recommendation.
Okay, maybe I can bring Xander into this conversation because Christian's not here, but this is why I don't bother trying to time the friggin' market. I have no idea what's going to happen. And so, but you and Christian feels like Christian will tell me that, when it's high, you should sell. When it's low, you should buy. And I'm like, I don't know. All I know is Tesla's a good company and we'll ride this out. And maybe it's gonna definitely succeed. That part I have no issue. But am I wrong? Am I supposed to be selling my stock now because there's going to be it seems like the world's going to crash in the next several months? Mm-hmm. I don't want to sell my stock. In fact, I'm going to buy more. I'm going to keep buying, protect myself with cash, more cash than I normally would have is what I'm doing. But I'll buy as much as I can. What's your approach to this?
I think we need to remember that we're long-term investors, and these short-term moves that occur are, they're surprises. So you can't predict them. So I don't think that it's very possible, and most people can't do what Christian does with saying that he can time it. But I just think it's just what Alexander's doing, dollar cost average. If you're worried about the markets in general or equities, I think moving to instead of buying up equities, move it to a safer vehicle like treasury bills or so I kind of think about that. I don't try to play those games too much. I look at this downturn as an opportunity to earn money and then deploy it into the stock, because I'm not done building out the position. I think that ultimately this company is going to be the biggest in the world. My thesis hasn't changed. So I just like I've always done, I play around the edges with the portfolio by, selling calls when I see a big rip. If I see a big decline, I'll try to play the put game, but that is dangerous, as we saw with running into margin calls and things like that. So, but that's just overall, I think these types of events occur, and we don't know where it's going to go. But I just think just focus on the fundamentals and just look at it that way. And by the way, I don't have a dog. It's Alexander's. or Farzad.
Did you guys see that comment that said, thankfully, Tesla is more than just a car company, but it is seen as a car company today. Now, if there is a major downturn, if there is the auto macro is swept into it, and all the other OEMs, or at least a few of them, show bad numbers and show that they're declining, Tesla will get swept in. Isn't this an opportunity for Tesla to step up with energy, somehow show that energy, as Elon has said, is not going to be affected by the recession? It is unlimited demand. It's got higher margins, easier to produce. Would they somehow kind of project and say, hey, we are an energy company, and look, we're going to redirect our efforts or invest more in energy? Is that even a possibility, or is this really another wait till next year kind of scenario?
I think Tesla is going to project themselves as deflationary in every category they play in, whether it's the auto industry and them leading, visibly leading on price reductions and value, increasing value. They're reducing prices, but they're also increasing value to consumers based on the value per dollar, what consumers are getting in terms of range, performance. Same thing on energy. Replacing these peaker plants with Tesla Megapack solutions is not only more sustainable, but they're going to actually help reduce energy prices in aggregate over time. So opening up their that was a Tesla funded supercharger network, and they're opening that up now, so more people have access to, and they're selling electricity through their supercharger network, and they're going to do well doing that. By the way, they're not going to lose money doing that. So I think, Tesla, to your question, Herbert, I think Tesla is going to position themselves as producing, deflationary solutions, for the marketplace, and more value for consumers. So I think it's a good thing. One other thing I did want to note is, I was just looking at the technical data on the S&P. So we shot up to the 50-day moving average throughout the day. I think we got up to 40, 30, 40, 30, 25 and change. And that was we shot up to the 50-day, and we closed on the screws on the 200-day moving average of the S&P. So technically, we didn't break below the 200-day on the S&P. If you were to close and break meaningfully lower on the 200-day of the S&P, then technically something happened with this presser and the market reaction, but really technically nothing happened. Just wanted to put that out there.
From my standpoint, I think the energy piece is a very interesting one, because I think it will showcase Tesla's ability to explore multiple verticals with the same supply chain, and it should become a bigger strength as we go into the year, especially with a backdrop that could cause, say, the auto side to become, let's say, the margins get impacted dramatically because of a severe recession or a severe economic downturn. In a good outcome, so here's the weird thing about the Tesla story, in my opinion, not financial advice. I feel like I always have to say that, right? In a good economy, I think Tesla performs well regardless, because they have the best product, they have the lowest cost, they have the highest margins, they have the largest scale for affordable EVs, especially with the Gen 3 car coming out here soon. They have a brand new pickup truck coming out that's going to eat into the pickup truck market. Model Y is ramping 2 million cars in 2023. Great. That's in a good economy. In a bad economy, Tesla is the only one with pricing power from a car perspective, where they can afford to go down market and ship more cars for cheaper. And yes, that will impact their profitability, and the stock price will likely take a hit because of it. But they are the only car maker that can do that. Literally the only car maker that can do that, especially if you think about it, a affordable, compelling electric vehicle instead of the Model 3, or maybe a standard range Model Y. And within that too, you also have to think about what the governments are going to do in the case of a severe economic downturn or say recession or God forbid a depression. Typically speaking, and y'all tell me if I'm wrong, governments like to stimulate the economy. They like to sort of step in and be like, hey, we're going to sort of encourage you to spend on the next thing, right? So back in 2008 was cash for clunkers, right? Get rid of your stupid car so you get a better car. And here's a huge rebate, right? In 2023, we have the EV tax rebate, but in the case of a recession, I would not be surprised, or a severe economic downturn, that governments stimulate the economy with the next generation of technology, which lo and behold just happens to be an electric vehicle. So even in that scenario, I feel like Tesla would perform really, really well from the standpoint of being secure as a company and positioning itself for the next decade, the long term. What it does to the stock short term, I have no freaking idea. If the market is pricing that in long term and saying, yeah, you're obviously one of the winners, a clear winner, so we're going to price it in starting now, that could happen. Or they could say, well, we're going to treat you more as a company that we want to price based on the short-term execution. We want to make sure you survive this crazy downturn. We don't even know if people are going to be able to buy cars, and so we're going to punish you for it. But in the end, I think either side of the economic spectrum benefits Tesla, which is weird, in my opinion. Those are my thoughts.
Yeah, and just put yourself like, what if we were, we're Tesla focused on this conversation. What if we were GM focused and we were responding to this Fed? This Fed presser. Well, what are you looking forward to? Well, right now you don't have supply of EVs. You don't have a cost structure to capitalize it. And to capitalize it, you're going to need to borrow money, which rates are super high right now. So, and then even if you could get a hold of the money, let's say credit markets are okay, and you could get a hold of the money. Right now, the only EVs you know how to produce are at negative gross margin or maybe break even. Best case, they've said it's going to take them 2 years to get to between 1% and 5% gross margin on EV. So if we were to put ourselves in the shoes of some of the other legacy automakers, it's like it's not forward looking in terms of like what they're working on right now, and the product they have to ship right now is, I think they're building up tremendous inventory on their product right now, and I think the data is going to show that. It showed it in the prior quarter. Whereas Tesla right now is producing a product line that we believe is actually increasing in demand based on everything that we're seeing out of Europe, out of China, and the US data. So, I mean, just much better if you go from macro to micro and say, okay, you're Tesla focused, everything that they're working on, whether it's in auto or energy, seems to be an increasing demand, even in a macro environment of, kind of like a little bit of a wet blanket kind of macro environment. There's these green shoots that they're working on that could increase. And we've seen this with other product lines too, during the Great Recession, the financial crisis in 2008. We've seen other product lines, discretionary product lines, just double, triple, and shoot through the roof straight through that recession period. So it's going to be interesting to watch.
Yeah, I agree with you, Jeff. But then my question is, why is Elon so vocal that he really wanted a rate cut? And I think it is actually because it also affects Tesla suppliers. It also affects their negotiations in whatever they're currently purchasing, exploiting, and whatever. So there must be niches of Tesla that are not the main business. I agree that both energy and the cars are probably safe. With the little reserve that there may be people just delaying their car purchase. There may be people that today were thinking about a new Tesla or changing from a current car to a Tesla, saying, okay, let's give it another 6 months or a year before we do it. But even if you take aside that, who are the secondary and third level partners of Tesla that are going to suffer from this rate hike? And I do believe that must be a concern of Elon. Otherwise, he wouldn't be so vocal about it. Because calling for minus 50 yesterday, other than making us all laugh, he had a reason to do that. You just when you're Elon, you know that every and any tweet you put out there will be scrutinized. So by doing that, he obviously had an objective.
Yeah, well, for sure. Sorry, go ahead, Herbert.
No, go ahead, respond.
No, I think it's a good point regarding Tesla's suppliers. And it's also, and this is what OEMs do, is they look at the financial health of their suppliers and they look at the weighting of what they ship to Tesla versus what they ship to the rest of the industry. And actually what they don't want is they actually don't want suppliers that are, heavily 80-90% plus dependent on Tesla. They would want them to be distributed throughout the auto industry. So where the concern comes into your point is like, if there's a pretty big slowdown in other auto and Tesla's using some suppliers that also work with legacy auto, that's where the concentration risk could occur, where now most of their business is with Tesla, or their access to capital becomes more expensive and they have to pass those costs on to Tesla. But and also in these conditions, there could be some deflationary aspects to it as well. So it may be a mixed bag. It's going to be hard to tell. Elon's got a tremendous amount of capital out in the marketplace. He's got Twitter running. He's got obviously with Tesla and SpaceX. He sees goods pricing. He's probably one of the better windows into the PPI, the producer price index, than anyone. So I take what he says with great seriousness. There's just other aspects to inflation as well that he may or may not be seeing. He may be right. These things are hard to call in the moment. It's more of like, well, where are we going to be 6 months or a year from now? And that gets all the way back to a tools discussion with the Fed, which could be another hour-long show of why is there such lack of predictability.
And what's interesting is that, if I could just throw 2 cents in, he's like one of the very few ones that has that type of window, right? So he's in multiple industries, but he's in the industries that are really the engine of the American economy, which is manufacturing. Like manufacturing is where it happens. This is like one of the primary drivers of the economy. So that's one thing. And then he is one of the very few leaders that are part of this sort of, call it the CEO rank class of our society, that seems to be comfortable saying these things publicly. Whereas if any other CEOs or leaders would signal something like this, it might spell doom for their company, because they're like, oh my God, he's signaling this downturn. He's saying this because the company's in trouble, right? So that's another layer. So like there has to be something that he's seeing that's causing that kind of verbiage. I just wanted to add those because it's a fascinating point, and I think it has a lot of merit.
Right. So Alexandra, I look at it as a positive, not a negative, that Elon is saying that he wants a 50 basis point rate cut. And because I think that, like both Farzad and Jeff just said, that he has good visibility in supply chain, and he sees deflation, not inflation. And so he says that the biggest issue is banking crisis, not inflation anymore. And also you need to do something drastic. You can't just kind of like come back with something that a market is expecting. You need to flip the market sentiment and then right size everything. Right now, it's complete opposite of what they just did. They're scaring the bejesus about everybody, and they just said, "Oh, bank crisis, fine."
True.
And for me, and I guess other people will say that bank crisis is worse than inflation. Now you gotta figure this out. But banking crisis is like the world is ending. That's what happened in 2008.
Yeah. That's what we said yesterday, right? Remember?
Yeah.
Bank run, bank run.
I actually think that Elon can see deflation, and he's saying that's why I'm actually thinking that we'll see better margins than we're expecting, because his supplies is getting better, and so he does not see the inflation that the rate hikes have already caused deflation happening, and he sees that happening, and he can feel it. He can actually buying. Lithium prices are falling, everything's falling, and so, anyways, that's how I look at it. Not that. Not the negative that the world is going to die, but now it might.
Yeah. The one good takeaway I did take away from that Fed presser was he mentioned credit multiple times, and that the frustrating part of it was we don't know the extent or the depth. We see credit tightening, but we don't know the extent or the depth. That's a little frustrating. He's like, hey, it just happened. We're in the moment. But it also tells me that they're sensitive to it. And if they had to do something off cycle, let's say a couple more banks failed or something became more serious, or this actually leached over into another industry like auto, I believe they would be able to take action pretty quickly. But again, you kind of don't want that to happen. So it's more of like, where do we see inflation going? It's not clear, but you almost would want them to be a little bit less reactionary and a little bit more confident in their forward predictions and sticking by it versus like, hey, we're just not sure of the depth of this. And he was also
exactly
very clear.
Jeff.
Yeah, he was also just one more
that's
point.
Exactly. It's so swampy.
Yeah, and just the other point is, I guess I just lost my train of thought, but yeah, it's totally fine. I probably spoke for too long, but yeah, the depth and the extent of what just happened with the banking piece, I think is the thing that they're so unsure about right now. And he said it was basically worth like a rate hike. It was worth, it's almost like crediting it with tightening between sessions almost. Anyway.
Jeff, don't worry. I'll make sure Alexandra never forgets. Don't worry. I got you.
You will, right? Thank you for that.
Because I'm a noisemaker.
At all.
There you are. There you are. But I completely agree that and that's why I tried to say earlier, and Herbert summed it up really well. I'm fair enough about the 25 basis points. The market expected that. But what is really bothering me so much is we're confident in the banks. Nobody's currently confident in the banks. And then saying, but we'll have to see how this plays out. We don't have any indicators yet whether the banks will tighten, whether credit will become more difficult to obtain and whatever. And then it was we don't know. We don't know this. We don't know that. That was the worst thing. I mean, the one thing I had expected from them now was coming out confident. And even if it would have been confident, okay, today was 25, there may be another 25, but it all became a maybe, we don't know, maybe this, maybe that. We have to wait. We just have to wait. That is the main. And that's actually for me much worse than if they would have been clearly dovish or hawkish, because they were not. They were not dovish or hawkish. They were just trying to fill the room and hope this hour would go the quickest possible and he could just leave. And the other thing I noticed, much more than usual, he was scripted. Came a question, he looked for his paper and then read the 4 or 5 bullet points and then gave it back. So he was really trying to not interact and get out of his script. He was very much focused on just watering down the message, nothing too clear. And that's what really is bothering me, because we're not in a moment for this soft talk. We're in a moment where we needed some guidance, and we really missed that. And I think that's what the market is now acknowledging.
That's a great point.
Yeah.
Just to give you a heads up, I do have to run. You guys can continue, but I just have to run. So I want to thank you for hosting us. Really appreciate you.
No problem. Hey, Farzad, before you go though, you were supposed to fix Alexandra's lag, and she still has a lag. We need to hear her talk properly.
Every time
Please
she's been on my streams, she's been fine. So maybe it's on your end, bro. How about that?
Oh my God. Okay. All right.
I'm just saying.
Take a look. All right.
Yeah, we'll take a look. All right, everybody. Thank you so much.
See you later.
Thank you.
And then Jeff, some people love your background, and I want people to take a look up here, and you tell me what this is. But right where the books are, there are bookends, and they look like the robot hands. Are they the bot hands, Jeff? What are they?
I'm going to leave that mystery. I'm going to leave that as a mystery. Yeah, and it
look at the bot hands. And we know that you're very well connected with the Tesla executives. You have back channel communication with them, and I think that you took the bot hands.
We'll see. They do look very robotic. There'll be Easter eggs maybe every episode. Tune in and watch.
How did your dental procedure go, Jeff?
I guess the more we've gone through the show, I'm able to talk more clearly. But yeah, it's okay. It was a root canal.
Well, thank you for jumping on.
Good as a root canal can be. Yeah, thanks for asking.
Okay. Well, thank you guys very much. Yes, I do need a producer wife. My wife, we're going to call her Brighter Wife. Alexandra's been calling her Brighter Wife, and so we'll do that. Thank you guys very much for your time, and that was another great conversation. See you guys. Bye, everybody.
Thanks, Herbert.
Bye.
Thanks.